What is up, everyone? It's Daniel back here with another video. Now, in today's video, it's going to be a little bit different. I'm going to be discussing exactly why Bitcoin's price and the price of basically a bunch of other cryptos, because they're all related, has fallen in the past few months, specifically since October 2025. If we look at charts here for Bitcoin, like Ethereum and Solana, as you can see, it's just been basically on a downward trend. Now, I typically make videos more about AI, but crypto is something I used to be really interested in. I feel like given my previous knowledge and the fact that I still keep up with it from time to time, this knowledge that I'm going to give you guys today can maybe help you guys like understand why Bitcoin and other cryptos is falling a ton and maybe help your decision moving forward on how to invest. Now, there's a few points I want to cover on why it exactly fell. So, point number one is regarding the Federal Reserve. Basically, in late January, Trump nominated Kevin Warsh to replace Jerome Powell as Fed chair when Powell's term ends in May 2026. The important detail is that Powell hasn't actually been fired. He's still fully in charge right now. So why did the markets freak out? Warsh is seen as someone who favors tighter liquidity when it comes to the Fed balance sheet. This just means that he wants a smaller Fed balance sheet, right now it's around $6.6 trillion, and less easy money sloshing around the system. Even though Warsh has talked about cutting short-term rates in certain scenarios, investors focused on the bigger picture, less liquidity overall. And Bitcoin, the thing is, it loves liquidity. When money is cheap, abundant, and has a low interest rate attached to it, people chase risk. They invest into stocks, crypto, memes, everything. And when liquidity tightens, investors do the opposite. They sell volatile assets like Bitcoin, like Ethereum, like Solana, first, and then move that money into cash, bonds, or treasuries. Basically, very simple, very safe assets. That's what exactly happened after the nomination. Bitcoin dropped over 7% in a single day, falling from around $84,000 to the high 70,000s almost immediately. The market started pricing in a future with higher real rates and less support, even though the leadership won't actually change until mid-2026. The next point is that Bitcoin doesn't trade in isolation. It's been moving more and more like a high-risk tech stock. In 2025, AI hype pushed markets to extremes, but recently cracks started showing. Earnings disappointed, Microsoft Azure's growth completely missed expectations, and suddenly the whole AI will save everything narrative cooled off very quickly. So when tech stocks sold off, basically Bitcoin followed. At the same time, even traditional safe havens like gold and silver dropped a lot, which tells you this wasn't a rotation of some sorts, but it was actual fear. When markets go risk off, investors dump anything volatile. And right now, Bitcoin is basically being treated as one of the most speculative assets on the board. That's why its sell-off accelerated alongside tech. It's trading like a leverage bet on sentiment, not digital gold. Now, point number 3, is regarding massive Bitcoin ETF outflows. Bitcoin ETFs, which powered a huge part of the 2025 rally, basically started bleeding capital. Since the October peak, US spot Bitcoin ETFs have seen around $6 billion in net outflows. Some weeks saw $1.6 to $1.8 billion pulled out. One day alone in late January had over $800 million leave in 24 hours. This was mostly institutional profit taking. Big funds rode Bitcoin from under 100,000 to 126,000 and decided to lock in gains. The problem was that new buyers weren't stepping in fast enough as prices fell. When ETF money exists, it removes a major support floor. Less steady buying means every dip hurts more. That's why Bitcoin struggled to hold key levels. The ETF bid that propped up the market in 2025 just wasn't there anymore. Now, point number 4. I want to point to this article right here. Leverage has simply been brutal. On October 10, 2025, Bitcoin experienced a flash crash that wiped out around $19 billion in leverage positions in just hours, one of the biggest liquidation events ever. That kind of event actually simply leaves scars because, that's a bunch of money that just disappears. And since then, traders have been jumpy. Every dip triggers forced selling. Just in late January and early February, we saw another $2.5 billion in liquidations, including one of the top 10 largest liquidation events on record. This literally creates a vicious cycle. Prices dip, leverage positions get liquidated, exchanges sell automatically, price drops more liquidations, and weekends make it worse because liquidity is a lot thinner. That's why moves feel sudden and violent lately, basically. Leverage keeps turning small drops into massive big crashes. Point number 5, a system-wide liquidity tightening. Liquidity across the financial system is simply shrinking right now. Bank reserves at the Fed are declining, and more institutions are tapping short-term lending facilities. That's basically a sign that money is getting tighter, not looser. When liquidity dries up, markets become thin. Volume drops, rebounds get weaker, and even moderate selling pushes down fast. There's simply less capital available to absorb selling pressure. Bitcoin, being high risk, feels this first. With less cash available, investors de-risk and sit in cash instead of buying dips. That's why recent drops feel exaggerated and recoveries feel very slow. Next is regarding macro and geopolitical uncertainty. The macro drops, in really simple terms, is very ugly right now. We've got renewed US-China tariff tensions, trade war fears, mixed job data, lingering inflation concerns, and even a recent partial government shutdown. On top of that, geopolitical flare-ups like US-Iran tensions basically keep markets on edge. When uncertainty stacks up like this, investors don't care about narratives. They care about survival. Capital flows out of volatile assets like crypto, regardless of long-term fundamentals. Even with some pro-crypto political signals, the macro fear has dominated. That's why Bitcoin keeps grinding lower instead of bouncing up. And final reason is this is just how cycles work at the end of the day. After the massive 2023 to 2025 bull run, ETFs, the halving, election optimism, Bitcoin entered some sort of a digestion phase. Every cycle has one. We saw similar pullbacks in 2019 after big runs. The hype faded, attention shifted back to AI and equities, and Bitcoin started trading more like a correlated risk asset. Many analysts see this as a healthy reset, not a death spiral. Historically, 30 to 50% correlations after euphoric tops are perfectly normal. Some see potential local bottoms around 70,000 to 75,000, while bears warn macro conditions could push it lower if liquidity tightens further. This phase is about shaking out weak hands and resetting expectations before the next real trend forms. That said, thank you guys so much for watching this video. If you guys really like this quick crypto update, please let me know in the comments below, and I'm happy to create more videos like these. And yeah, I will see you guys in the next one. Cheers.